All right, cool, guys. All right, so check this out. Welcome to Be the Market Expert. And like I said yesterday, we're going to go over what some of the slides they went over at Mega Agent Camp. And so here's just the data disclaimer. It says like, hey, this is as is. We believe it's right, and we'll see what it looks like. So let's take a look at this thing. So Mega Agent Camp, hosted by Gary Keller, Jay Papazan, Ruben, and then Jason Abrams are all typically on the stage, and they're having this discussion around these slides. And so whenever you guys can have an opportunity to go to family reunion, Mega Agent Camp, even the Rocky Mountain Summit this year, they're going to have Logan Motoshami, who we're constantly having conversations around his information, like great places to be from really smart people. But here's the market update. It's the US economy. Here's the conversation, right? And this is the conversation that we keep having week after week. And it's really where we're at. They're saying, hey, we are at a crossroads here where we're either dealing with inflation or unemployment. And the Fed's got to pick their battle, right? And they're saying, hey, what are all the things that are pushing this? We got the GDP, cost of money, tariffs, government policy certainty. And I'd say the government policy certainty and tariffs probably go hand in hand. Um, and the cost of money and GDP, I feel, go hand in hand as well. And I'll kind of explain that like as we go through this. But again, the Fed's got a decision to make, and we're seeing some divisions in the ranks. And we have seen this where some Fed presidents are like, we got to lower rates, and others are like, let's hold the course. And I don't think we've seen that in a very long time. They're pretty much united front, and now they're not. So we go through and they say we got ideology and policy. We're not going to get into this thing, right? But it says, your social policies can get you elected, your economic policies can get you unelected, and your foreign policies can get you reelected. We're not going to dive into that. Let's look at the GDP though. All right. So your GDP, your gross domestic product, right? And you can see that we're sitting at 1.4%. And that's where it's projected, right? So that's saying that, hey, we've got some other things that are going to have to happen. And I would say that's probably optimistic. And this is why I say that. Again, I don't have a crystal ball, but when we look at this is the stuff that is built in the United States, right? This is really your professional and business where we're looking in this. And when we talk about what is built in the United States, where does our money really come through? Where does the revenue look like? Well, real estate, rentals, leasing industry. And then when we look at professional businesses and governmental, we can look at like general service-based industries, right? Like that's kind of where we dominate. We don't have a lot of goods, right? We're not building a lot of stuff in the United States, right? When we look at this thing, and that's been the whole policy with the current administration, right? Is that we want things in the United States. And here's the deal, like, feel free to go build it wherever you want. It's just going to cost you more to bring it in. And that's been this whole conversation, right? We've had this conversation in the past where iPhones, right? The iPhones is the big one, and there was that article that was like, your iPhone's going to cost you $10,000. And it's like, what world is anybody going to buy a $10,000 iPhone? And so when we talk about, oh no, they're just going to pass it off to the consumer. Yeah, yeah, maybe, but there's a breaking point for all consumers where they say, you know what, this dollar amount's not worth it to me, and you go and you choose a cheaper product, right? We talk about the principle of substitution in real estate all the time, right? We got two houses and they look the same. You have one that is more expensive and one is less expensive. You're going to choose the less expensive house. If it's a three bed, two bath, neighborhood A, neighborhood A, pretty much is this, you're always going to choose the cheaper product. And so when we look at the GDP, this is where it gets interesting, right? Because when we talk about this, that also is tax dollars. That also is employment. That is so much stuff. And a lot of it is real estate driven. And that is why this number is so low right now. We're pretty much a consumeristic society in the United States, right? We buy product. We go into Amazon, we prime it, we get it tomorrow morning. We got to pick our window 4 to 8 a.m. Or do we want it 11 to 3? Or do we want the in-garage delivery, right? Like we have all these different things. And like in the United States, we pretty much just consume. And so we're not building a whole lot and sending it out, right? We do some agricultural and some other stuff, but most of our money comes from real estate. And then when we go through here, oh, and just so you guys know, like the United States, we don't have like a fixed number that we're looking for. We think that a healthy range is like 2 to 3%. But when we're looking at this and the overall health of the economy, we don't have a this is our standard, but we kind of want to be between 2 and 3. And so you can see that we've kind of fallen off here. So let's talk about unemployment. And when we look at unemployment, here we go, and we're at this 4.5. So this unemployment, again, the Fed has this dual mandate, right? We looked at that circle, inflation or employment or unemployment, I guess. And so when we look at this, again, we don't have a formal number, but we want to be within 4% unemployment. So this thing, as it's saying, hey, you know what? We were at that 4% mark. We were right at the ceiling last year, and we're predicted to go through the ceiling this year in 2025. And so this is the crossroads that we are at. Do we try to make the cost of stuff cheaper? Or do we try to make sure more Americans have jobs? And that's what the Fed is having to do. Like they want to try to balance it, but there's a lot of smart people out there believe that there's no balance in it. These guys, these have, inverse correlations to one another. So here you guys go. We're looking at unemployment. And again, when we think about our segment, when this thing starts rising, what do? They historically they drop rates, right? Like that's kind of what this thing looks like. So here's your unemployment job openings, and this is just your graph. If we look at this thing, job openings and unemployed people, this is in the millions. We look at this unemployed people right here, 2020. I guess this would be like the gold standard of, oh my God, things have gotten bad. And right, we lived through this global pandemic, right? I remember where we didn't even know if we were allowed to like leave our houses. And so not a whole lot of job openings and a lot of people without jobs. And yeah, these are kind of the same right here, but we're seeing job openings kind of tick down a little bit, and we're seeing unemployment numbers go up. And this is where we're going to see some red flags pop up. Your inflation data. All right. So when we talk about the inflation data, the Fed wants 2%, right? 2% inflation. And this is right, we're talking about inflation versus unemployment. And here's your number right here. And if we were to look at this thing, this is your CPI, this is energy and food, and this is excluding energy and food. And here's your target 2%. Again, 2% is where we want to live. And while we were able to bring it down, it's still not at that 2% number, right? And we see we've gone through, and outside of a couple of things, right? And again, food, energy, right? We talk about gas, we talk about the cost of eggs, right? That was a conversation we were having for a very, very long time, and eggs are still not cheap, right? But as we go through this, they're trying to go through, and this is really just the cost of stuff. Can we get the cost of stuff cheaper? And they want to be at this 2% number. And when we're going through, guys, look, here's a recession. The cost of stuff got cheap, right? We go back to 2020, global pandemic, the cost of stuff got cheap. And so we kind of go back and forth depending on what is happening. And so again, when we start getting to these recessionary red flags, this is one of those things where they're going through and they're looking, do we make the cost of stuff cheaper, or do we make being able to expand and have businesses and pay people easier? So do we drop rates? And that's where we're at. So let's look at the real estate industry. Here you guys are. And so here's your annual home sales. And so guys, we've been pretty flat, right? We've gone through this, and this is when we talk about recession, right? There's no such thing as a real estate recession, but yet we feel it disproportionately because the cost of our product is way higher than most products in the United States and in the world. But when we look at this thing, right? So here's 2020, 2021, we had more sales, right? Global pandemic, cheap rates. Rates were cheap in the first half, and they skyrocketed, and then they stayed elevated. And we can see this, but guys, this is 4.1 million home sales, and they're projecting 4.2. So we look at this and say, okay, cool. So houses sales have gone down, and we can look at it right here as well. And again, this is in the millions. So 2025, we had 7 million. 4 million, 6 million, 4 million 2024, and they're saying 4 million again in 2025. Well, then just your monthly sales, we can kind of see it kind of go up and down. 2024 is the purple, right? It hasn't happened yet. Again, everything else is rear view facing data. We like to look backwards. And then so we're still waiting on 2025. And you can see like we've been relatively flat all the way across the board. So again, shaping up just like 2024. But here's what's interesting. All right. So we just looked at this. All right. Less home sales. We all get this. We can all look at this, less home sales, right? And if anyone does not get that from this data, reach out to me and I'll talk about it with you. Less home sales. But here's the deal. You guys are living in a time period where the average home is going for way more money, right? Especially in Colorado. You have a price point that's at $600,000. And so we don't live in Mississippi where their average price point is around what, 200,000, maybe three. And so when you go through and you look at this, you guys, while we are disproportionately affected, when you go out and you find the motivated, your guys' commission checks are way higher than the majority of the nation. And so this is where you guys are living. We know since 1990, historically speaking, we have this 4% appreciation line, right? This is what this is. This is saying, historically speaking, since 1990, homes have appreciated 4% year over year. And obviously, there's some outliers. You guys are living in a point right now in 2025 where we're still 8.3% above the trend line. And so I think this is worth the conversation because I think that there's many news syndicates that are out there that are saying Americans are losing money. Well, okay, maybe, right? Like maybe if you bought in the height of 2021, you overpaid in 2022. I don't think people were doing anything crazy in 23, 24, or today, right? We're not waiving all contingencies going $100,000 over asking. Like we're not seeing that. So yes, I guess if you were to have overpaid and then now you're being forced to sell your house, but I think that's important. You only lose money if you sell. And so when we're looking at this, guys, check this out. Like these people in your world that bought in the 1990s and the early 2000s, look at this. Like, here's the average $222,000. And again, this isn't Colorado numbers in 2006. And then on average, median, I'm sorry, $418,000. People aren't losing money, right? Like this is a false narrative as we're going through and we're looking at this thing. People have equity in their homes. There's a ton of equity in people's homes. And so again, like as we're going through, yes, they could have bought in a time in the last couple of years where they overpaid. And so yes, if they were to sell, they're going to lose money. Very likely. And yet, if they bought anywhere in here, guys, check this out. Like there is huge amounts of equity in a lot of people's homes right now. Here's just your inventory, guys. We're climbing. We see this. We look at this every week. Inventory is climbing. This isn't necessarily a bad thing. The only issue that we're running into is the cost of money. And so if the Fed answers our prayers, right, what we're going to see is we're going to see interest rates come down. We're going to be able to see that those rates are actually going to come down and we will see more people actually go and pull the trigger. Your new home starts. Now, this is interesting. And so new home starts, it's getting slower. So this is new builds. New builds, right? They got caught holding the bag here. They got caught holding the bag, right? With all this inventory. They were building, and oh my God, too big to fail. The Big Short, watch it, find it out there. Watch The Big Short. If you have not, that's great homework for everybody. And they got stuck with all this inventory and no one had any money to go buy any houses. So they hurt. Now they're saying, we're not getting caught holding the bag. We are going to produce just enough inventory to keep the spigot tight, right? Slow drip. And keep in mind what they do in Colorado. For the most part, they're not building on spec. You go deliver earnest money on a piece of dirt and they'll say, we'll see you in 12 months and your home will be ready. And if you decide to walk away, we're going to keep your earnest money, right? These guys got smart. They're not going to be caught. They're not the March of Dimes. They are not a nonprofit. And if anyone went to Toll Brothers with us over last week on Friday, right? You heard the new build, right? She's like, oh yeah, we're just slowly bringing out inventory. Yeah, to keep prices elevated as high as possible, right? Hey, we don't have enough inventory. This is what you can get. We might be releasing inventory in a couple months from now, right? Like that is the game that is being played. Your mortgage rates, guys. So check this out, right? So we look at annual mortgage rate percentage. Here we are, the blue. Here's your historical average from 72 until 23. And here's your historical average from the 1990s to 23. So green, 6%. That's 1990s to 23. 72 to 23, 7.72. Guys, look at this. We got lucky, right? And again, we didn't get lucky because then it just got bad from there. But like we were spoiled, right? When we look at when 2021, when money was free because we were getting off a global pandemic and they were looking to stimulate the economy by saying, guys, here's money, go spend, go put money back out there. That's why we're in the situation that we're in right now. But guys, and I get the prices have gone up, and I get the wages have not kept up with inflation, and yet the mortgage rates aren't necessarily high. They're high in proportion to what people are making and to the price of homes right now. And yet we do know there's a bunch of incentives to help buyers go out and purchase. So here's just your rates and this roller coaster. This is kind of what scares people as we're looking at this information. But here's January 16, 387. Then we got to 268 in 2020, 3% when the world's like, oh yeah, it's not going to end. We're going to get through this. People started spending. We had this massive skyrocket. This is what scared people in 2022. It's not the rates got outrageous. It's how quick they went up. This is what backed people off. They said, whoa, 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 this feels weird. And then we just had these elevated rates from the end of 22 into now. They stayed elevated, and that's what slowed people down. So again, money was free. Then they skyrocketed very, very quick. This is the fastest we ever saw money go up, right? Like you can see this here since 2016. This is what scared a lot of people. We went from 3 to 552. And then it has stayed elevated. This is what's slowing people down. So your affordability, here we go, guys. So 33, right? P&I, this is principal and interest as a percentage of income. So it's saying that 33% of people's income, their monthly payment or their monthly income is going to principal and interest. That's not taxes or insurance. That's principal and interest. And we know that insurance is going up. And so send David mail later saying, hey, let's bring insurance rates down. So when we look at this, right, this is where we are. And principal and interest, 33%. Like that's high, guys. That's why people are slow to pull the trigger right now. That's why they're going out there raising their hand to figure out what they qualify for. And they're saying, does this home check all the check boxes? Because 33% of their check is going to go to housing. That's not their cell phone bill. That's not their Netflix account. That's not their kids' schooling. That's not their food money. That's just principal and interest. We go through, we're not going to look at Canada or volume per agent, but you guys can see this as well. With less agents in the business right now, we're actually seeing the average agent, 3.21 deals. So we go through method of home purchases. Guys, you can see this, agent or buyer, 88%. That's the only conversation we need to have. 88% of deals are going through real estate agents. What buyers say that they would prefer in their home buying process. We look at this thing, finding a home, prefer a person, 48%. Trusted AI tool, 23%. Trusted both equally, 29%. So we go through here and still the majority rules. And so when you're going out here and you're doing these different things, what it gets weird is that it starts going down. They say, you know what, we're actually okay looking for home insurance in other places. We actually don't need a person. Finding a mortgage, we actually don't need a person. Real estate, legal advice, they actually want to talk to a lawyer. But here's what that looks like. Importance to buyers when working with professionals. Guys, they want to feel comfortable with you. They want you to have confidence. They want you to be loyal to them. right? And so when we go through, what are we doing to make sure that people are comfortable with doing business with us? And we talk about social media all the time, right? Yeah, it needs to be a mixture of business, but we also need to mix our personal life in there. They want to make sure that we're human, not used car salesmen. 80%, guys, 80% of the people want to feel comfortable with you. What are you doing to showcase that you are a human? Internet revolution versus AI. We're not going to talk about this too much, but here you guys go. A lot of money is going in to getting AI tools up and running. We see this. This is the thing. The story of adoption, all we're just talking about is that what we see is it gets launched. We got these people that are early adopters, but what happens is over time, more people adopt pretty quickly. Then some things are like, oh, it's not really changing as much. And then we have mass adoption at the very end, like as things are kind of finished out. So your housing market. So check this out, right? We talked about the housing permits, right? We talked about this, but they're saying like, is this a recession? Like, are we in recessionary levels? So this is Housing Wire. This is Logan Motoshami again. And so when we look at this, we can see, guys, here is 2022, and they've just kind of gone down. And these are permits. So they're going and actually they're pulling permits from the cities. Well, then what's interesting is like this is the starts. Are they going through and are they leveling the land? Right? Do you see the trucks out there where they're spraying water and then they're bulldozing and they're bulldozing? Like that's your housing starts. So you can see permits have dropped to 870,000 permits. And then the leftover permits, we have 939,000 from previous permits. So these are just pulled versus this how many stuff has been started. And then we have single family and construction. Like, are they building the houses? Guys, look at this. It has dropped. It has dropped pretty significantly. Look, this is 1.2 down to 800. This is 800 down to 621,000. And what's interesting, right? This is single family completion. So they're actually completing inventory and they're not starting them, right? That's what this is showing us. But when we look at it, what gets even more interesting is this is one of our big red flags, our recession indicators. We are seeing, it says all employees, residential specialty trade contractors. And so when we're going through, what they're looking at is they're saying, all right, do we have people with jobs? All right. So it says a key focus on his economic analysts has been monitoring the labor market for residential construction workers. As shown in this data below, we are seeing a downward trend. Here's your downward trend. It's spiked and it's going down. So they're watching this. So if we see less people, right, we see less roofers working, we see less framers working, we see less tile people working, we see less painters working. That means that we're not producing as many homes. And that is a red flag because, again, we looked at GDP. What is our biggest source of revenue in the United States? Housing. So all employees residential construction, again, it's kind of teetered a little bit, but not too much. And then builder confidence. All right, so builder confidence is getting just lower and lower and lower. Okay. So let's go to Logan Moshami and let's go to last week. And it says rates could be 80% higher right now if the spreads weren't so good. It says inflation data was warm last week, but mortgage rates remain near their low levels of 2025 because mortgage spreads continue to outperform. We're not going to talk about that, but it says the stability in the mortgage spreads has helped maintain these lower rates even as the 10-year yield has increased. We're not going to talk about spreads. We're not going to talk about the 10-year yield. But let's look at housing inventory. Here we are, 23% more inventory right now than last year. So year over year data, 23% more inventory on the board. Guys, these are motivated people. These are motivated sellers that have been sitting on the market looking for an offer. What are we doing to move our buyers forward? New listing data, we can see this. Here we are in 2025. It did peak up a little bit, but we are in this downward trend because of seasonality. So again, like as we look at this is not surprising to us. This is not red flags. This is not, oh my God, what is happening? This is called seasonality. And this is rear view facing data. Kids are going back to school. right? Like this is nothing crazy to us. Now, here we go. This is exciting. Price cut percentages. 42% of all homes have had a price cut. Guys, if we were having this conversation pre 2024, 1/3 of all homes, historically speaking, have taken a price cut. We're sitting at 42%. And so this could be all kinds of different things. This could be they had unrealistic expectations for the price of their home when they put it on the market, which is probably like all of them, but some of them are super unrealistic. And then when they go through, they could be having to cut the price because a new home just came online and the principle of substitution, right? Or they're finally just got to the point where they're like, you know what, we actually got to sell this house. We're tired of waiting. What do we need to do? And is the home stigmatized? So, like, guys, as we're looking at this, we need to be making sure, as the real estate economist of choice, as a fiduciary for our clients, that we are presenting them with all the data. And we're saying, hey, Mr. and Mrs. Seller, what is important to you in this home selling process? And they're probably going to say, oh, to get the most amount of money. And you're going to say, awesome. What is your time frame? And unless they're saying, oh, yeah, a year, right? Which then you don't have a motivated seller. I mean, they're not looking to go to a year. Like they called you for a reason. If it was a year out, they wouldn't have called you. And so when we're going in, we're saying, awesome. Well, here are all of your competitors. And we're going through and we're saying, these are who we have to look better than. And we're doing the eye test, A or B, B or C, C or A, right? Like we're going through and we're doing all this stuff. And we're saying, does your home look better than this home? Does your home have a better kitchen? Does your home have a better bathroom? What is the paint? What does the location look like compared to the rest? And then we determine the price. Because if it's not better, we can't be more expensive. And we are being that fiduciary. We're getting comfortable having uncomfortable conversations to make sure that our clients are winning. You don't want to be a part of this 42%, guys. This is not a fun road. You know what this turns into? This turns into having to make a phone call to your clients every Monday to let them know what the showing activity looked like, to let them know all the conversations that you had with the buyer's agents look like, to let them know why aren't they having offers. So you know what you're going to have to do? You have to track down the buyer's agents. Remember when buyer's agents were super frustrated because listing agents weren't getting back to them? And now the tides have turned. And now you're tracking down buyer's agents. They're not answering their phone either. Like you don't want to be in here. Purchase application data, guys. Here we are. There's a spike. Kids going back to school. The summer is coming to an end. Good things are happening. So, guys, when we're looking at this thing, what are we doing? How are we getting back into relationship with people, guys? And I know I sound like a broken record, right? You're like, Charles, this is what you say every time when we look at this slide. And because it's very important, right? Like, what are we doing? Obviously, these people are going out and they're talking to lenders. And how sad are you going to be when you get invited to the housewarming party for your buddy that just bought a house with another real estate agent? So as we're going through and we're doing these different things, what are we doing to stay in emotional proximity to people so that when they're thinking about transacting business, they think about us? And so they're obviously going out and talking to lenders. Guys, this is what this data is saying. People are talking to lenders to figure out what they qualify for. Are you in the conversation? Guys, it's spiked up. Guys, not only is it higher than 2024, but we actually saw a spike. And who knows what this week is going to hold for us as kids went back to school. Your total pendings, guys, as we look at this thing, we're right in the hunt. Again, we're going to come off of this thing where 2022 was weird. We saw what interest rates did, and it started to do some odd stuff here. But we're going to be right in here, right? That's what this thing's going to look like unless interest rates just totally break, right? Unless we see the cost of money get significantly, significantly better, we're probably going to be still living in here. Now, if interest rates go gangbusters and we see a 50 to 75 basis point drop, we probably live somewhere up here, right? Like all those homes that are on the market that are online, they come off pretty quick. And again, new builds aren't building, right? We saw that. And so what this looks like is that we probably live over here. Your pending sales data is right here. And so your weekly sales pending, guys, we're right in the hunt, right? There is no difference here. We're right here, seasonality, nothing weird. So this week ahead, so this week right here, it says Jackson Hole, housing data, bond auctions, and Fed speeches. Fed Chair Jerome Powell will be speaking Friday at the Kansas City Fed Annual Economic Policy Symposium in Jackson Hole, Wyoming, making this a significant week to observe whether he expresses concerns about recent job data or maintains a focus on inflation. All right, guys. So this is Friday. Not saying that you need to set your watches so that you can tune into this thing. And yet, this is going to be a very, very important week for us. Because again, what we have to keep in mind is that these people of power with these big podiums, Jerome Powell, Donald Trump, whomever they are, when they say stuff, this is what causes either chaos or peace. That's all it does. Chaos or peace. And so when we're going through and we're looking at this, we are hopeful that they're going to go through and they're going to say something along the lines of we have some concerns with the job data, and we want to make sure that we're protecting Americans. Like that's what we want. And keep in mind, because this is the thing, guys, the people that are borrowing money to go purchase real estate, they borrow from the same place, essentially, from the people that are expanding businesses and hiring people. The money comes from the same place. And so when the cost of money starts going down, people can expand their businesses. They can hire more people, right? So it's directly proportional to helping us at the same time. Rates come down so that we can have economic growth. Then it also translates into the same place that people are receiving money to go purchase real estate. It says this week is also filled with housing data releases, including builder confidence data, housing starts, existing home sales, recent mortgage rates, right? We just talked about this, the housing data, right? We already looked at all that. Recent mortgage rates have reached a near year-to-date low. And so let's look at that. Here we go, guys. Here's 1 month. Here's 1 month worth of data, and this is from yesterday. Today's the 19th. This is from yesterday. Guys, check this out. Your 30-year conforming, let's call it 6.6. Let's just round up. And then let's call FHA 6.3. Guys, this is the conversation. Now I get it, well qualified. This is well qualified. Like they do massage these numbers a little bit, but these are well qualified numbers. And so as we're looking at this information, I think that we need to be going through and making sure that we're putting out the info. We're going to the barbecue, right? To Mitch's point the other day, that the rates have already been baked in, thinking about what is going to be happening, right? Like those numbers are already being reflective. And when we go through and we look at this, let's not go out and shout on social media, 25 basis point drop is what we already believe that we're going to see a 25 basis point drop. 50 would be cool. 75 would be even better. And yet, when we go through this, most of these numbers are already in place. So now we have to have the conversation. The headlines are doing the work. Now we have to educate. All right. You guys see that, right? Like the headlines are already going through and talking about the speculation and where the Fed's leaning and the discourse in the Fed, and we're seeing the division in the ranks and all this stuff. And it's getting people to think. And we saw that spike in purchase application data where people are going out to go figure out what they qualify for. And then what do we have to do now? We have to get back into emotional proximity, have conversations with people, find out what their real estate goals are, and say, you know what? Have you spoken to a lender yet? What does the lender believe? Awesome. Well, how are you guys seeing your houses now? Or I haven't spoken to a lender yet. Well, hey, I have a trusted partner that can actually give you a little bit more insight. They've been doing this for a very long time. They can actually tell you what the trends look like and then partner them with the lender of choice, right? Like that's the game that we're in right now, guys. Rates are not going to get significantly better unless we see a huge basis point swing. All right. So what do we need to be doing now is just have conversations. The numbers are the numbers. Like, we're not going to see them get significantly better at this. So, guys, as we're going through and we're looking and we're having these conversations, the interest rates have done it. Purchase application data, we just need to be making sure that we're having the conversations with our people because they're obviously interested. Now we need to show them how they can win.